introduce our speaker. Michael Simpson is a leading authority on residential and investment sales for 30 plus years. Thousands of real estate agents, brokers, and investors from around the nation have sought Michael Simpson's training. He is the founder and senior instructor of the National Commercial Real Estate Association, the NCREA, an internationally recognized expert in commercial real estate sales and leasing. His company, the NCREA, is a national training consulting and coaching company responsible for helping thousands transition into commercial real estate. Michael's curriculum and coaching programs have been attributed to producing many multi-million-dollar producers in the industry. Michael, thank you so much for joining us. We are really looking forward to this presentation. Over to you.
Thank you so much. Thank you so much, Brittany. I really appreciate it. And I want to commend NAR and you, Brittany, and thank you all for what you're doing. Bill Brown first mentioned this to me and was sharing what you guys are doing, and how 50% of the agents retire in real estate and they don't own a single asset. Correct me if I'm, if I didn't catch that correctly, but wow, what a huge number that is. And I thought it is so cool that you guys are doing this to talk about wealth and help people build wealth. And so we're going to do that today. We've got a lot of information that we're going to cover here for you. We'll answer questions. We'll stop right at the 45-minute mark and answer any questions you guys might have. So feel free to put any of that stuff in the chat bar. My business associate is Stephen Moraldo there. So hey, Stephen, good to see you. He's going to be typing some additional notes in the chat bar to try to make it a little easier for you as I'm saying things today. And I'm going to be giving you a lot of information very quickly. It's a great time to add commercial and or investment properties to your portfolio of services, folks. There's so much happening right now that causes me to say this. And we're going to talk about investing and you considering being an investor and thinking about investing in real estate transactions. We're going to touch on some residential transactions as well as commercial, because at some point people are going to go up against units. It could be 3 units, which really isn't commercial. It could be 5 units, which is. But at some point, we're going to start to look at commercial types of properties for investing. So we're going to touch on that today as well. I always like to talk about this. The future is here, but it's unevenly distributed. I remember when people started rolling the commercials out, talking about we're all in this together, and I thought, we're not all in this together. We're all in different situations. So many people are in different situations. You have, I saw something on the other day with Bezos, Jeff Bezos, Amazon founder. His income went up from 113 billion to 189 billion since March, since COVID kicked in, since the pandemic, up 76 billion with a B. Bill Gates up 16 billion, Zuckerberg up 42 billion. This is just since March. We're not all in this together. There is a huge wealth transfer taking place right in front of our very eyes. And it's not transferring equally, and it never will. And so one of the things that I like to talk about is your opportunity, and your opportunity to get your unfair share of the wealth that's out there. I started real estate in the early 80s. And what happened right after I got into the real estate full-time is the market tanked. I'm here in Long Beach, California, and we had some similar things that are going on right now. We have the Rodney King riots, we had fires, we had floods, we had aerospace industries closing down. Does any of that sound familiar? We're seeing a lot of that right now as I'm sitting here. My issue was, as an investor, is I was too new, I was too green, I was just focusing on sales. So all I did was put my head to the grindstone and start focusing on sales. And I didn't even think about real estate investing. And how silly was that? Gosh, we were selling homes for $125,000. That same home today is worth $550,000, $600,000. Should have bought more, right? I bought some, but should have bought more. And when I was at the peak of my industry in that time, the 90s, doing hundreds of deals a year, I saw deal after deal after deal after deal. Maybe you can relate to some of this, where you saw a deal, you didn't buy it, you decided to just sell it, take the commission. gosh, I did that so many times, and I really wish somebody would have been in my ear. Wish I would have had somebody in my ear saying, buy, and hold some of that stuff. Michael, don't just sell it. I just didn't have anybody telling me that, and I never really thought of it. So fast forward to 2008, I saw another market shift. And that time I said, okay, you know what? I'm going to get my unfair share of this transfer of wealth that's going to happen. But it took me a while to figure it out. One of my neighbors is one of the huge Los Angeles buyers at auctions, Wedgwood. He's one of the owners there. And I got to go and meet see the operations and the war rooms. And I was at auctions and I was learning about auctions, and I was invited to a Bank of America auction. I had money put together. I have one of my good friends, Tim, who's an REO agent, he's an investor. I got to learn from him. So now I was doing all this learning, and then I was ready, and then the market, boom, it bounced back up. So I kind of missed it. I bought some properties, but I really missed it. Well, this time is probably my third or fourth shift, and I've been talking to my team and people around me and saying, look, we need to take advantage of this opportunity this time around, because there's things that you guys can all do to capitalize on getting your unfair share of wealth. So I really want to encourage you to think, invest, think buy, think own, and not just get caught up on those commissions. There's a lot going on right now in the industry. There's high unemployment, lack of significant job growth, and limited capital are all working together to recalibrate the real estate market. A skilled and knowledgeable professional who can work with landlords, tenants, and even lenders will be extremely valuable during this time. There's so much going on so that you can just get skilled up to be able to have conversations with people. Eviction moratoriums in some states differ by county and even by city within the same county. Some cities and counties have imposed eviction moratoriums only on residential properties, and others on both commercial as well as residential. Sometimes, even when the moratorium covers both commercial and residential property, the type of property is handled differently as well. So it could be a different property type that's treated differently, multifamily versus, say, retail, for example. In some places, the eviction moratorium opposes obligations on the tenant in order to receive the protection of the moratorium. And in some places, the landlord is obligated to notify the tenant in advance of the tenant's moratorium rights. It's very confusing. You have a lot of owners of real estate properties in particular who are somewhat confused in certain situations about their laws and their rights and their rules and what they can and can't do. I had one of my students ask me if he could actually, when he was on a call, and he said, one of the clients said, gosh, my tenant's not paying. Can I even sell this property? Compounding the confusion are separate court closures and orders not to issue summons in unlawful detainer matters or for the sheriff not to do walkouts. To top it all off, the orders and moratoriums are changing from week to week or even day to day. Just constant change going on. So a skilled and knowledgeable professional who can work with landlords, tenants, and even lenders is so valuable during this time. So one of the things I talk about during a down market or a market shift or a little bit of a turmoil, if you will, whatever we want to call this that we're going through, is things are changing all across the country and changing differently in different areas, is that what happens is people who are skilled, the cream rises to the top. So people who are real knowledgeable and skilled and are up to speed on laws and rules and regulations, you have value, you have tremendous value that you can share with clients and use it to your advantage for investing in real estate transactions. In your in this slides, we have glossary of terms. And Stephen, what are you? I know you just recently said you're doing something with this handout. So in the chat, let them know what you're. Go ahead.
We're gonna get the chat, or we're gonna get the handouts to everyone.
Okay, great. So how are you doing that?
We're actually going to post it when the video for this presentation is posted.
Awesome. So when this is done, we'll put this handout out, and you guys can have all of these notes that we're talking about. So that's cool. There's some things that are not in here that as we go, I'm going to just say. Stephen's going to type that into the chat bar as well. Again, you guys, I'd rather give you a lot of information and have you be able to go back and use the recording and just pause and at your leisure. I'd rather give you a lot of information where you're going, wow, that was a lot of information, rather than you go, oh my gosh, what a waste of time. I don't want that to happen. So I'm going to load you up. So get ready, focus, concentrate, because otherwise this is so important. I can't think of anything more important in your lives than talking about investing in real estate. And if COVID didn't wake us up, I don't know what will. I mean, my gosh, when COVID hit, we were supposed to travel. We were supposed to do all these things, me and my company, and boom, shut down, stopped, business stopped, came to a screeching halt for so many people. And real estate agents were not even essential for a while there in certain states and areas. So I'm sure you had to look at that and go, oh my gosh, what am I going to do, right? Where's my income going to come from? That's why we invest. So this is important. This is extremely important. You've got these different calculations and formulas in here, and that's what we're going through. It's called terminology, glossary of terms. It's in the handout or in the slides, and it's going to help you with formulas and calculations that may occur, may come up, like return on investment is always going to come up, in my opinion, when we're talking about investing in real estate. And so not everyone understands the formula for that and how to do that. So I'll walk you through that, but that's an example of what's in here. Now I'm going to go through this quickly, and you guys, we can't learn everything there is to learn in 45 minutes. I mean, there's just no way, right? So understand that I'm going to throw a lot at you and then let you go back through it on your own time, maybe go to some other trainings that we have or some other things that are out there to really get your arms around this. These are called assumptions. Assumptions can be any scenario. What I like about numbers is that numbers don't lie, as they say, and you can look at any deal and you lay the numbers out and you know what you're dealing with. And so this applies to residential, it applies to commercial, it applies to any investment property other than our home that we live in. And what we're looking at is you can do this any way. You can look at 50% down, all cash. You can look at various ways. 25% down is what we're looking at now. We're looking at current rents, market rents, seller carry. I always like to look at the deal and say, okay, is this accurate information? Is what you're telling me, is what you're giving me, or what I'm looking at, is this currently happening? Are these numbers right now numbers, or is this some sort of market, some sort of pro forma, we call that projection, where people are saying, well, this isn't happening right now, but it could in the future. And so we want to know whether we're looking at real numbers, current rents, actual rents, for example, or some sort of market rents or pro forma or projection. Your GRM, the formula and definition is going to be in that glossary of terms. Sales price divided by SGI. Your cap rate, the definition formula is in that glossary of terms, NOI divided by sales price. Here's the price, $750,000. We're using a down payment of 25%. So when we take $750,000 times 25%, that's where I'm getting this number here, 187.5. And then we're going to subtract 187.5 from 750,000. And that's going to give us $562,000. That's the first trust deed. That's the loan that we're getting in this case from the lender. Now, in this example, you can change the interest rate. That's why there are assumptions, or the term. We're amortizing this loan at 9% over 30 years, and that's going to give us what's called our debt service payment down below. Now, notice what I'm calling our payment in commercial real estate. We're calling this a debt service payment versus a mortgage payment like we do in residential. Now, it's also important for me to pause for a minute here and help you understand a couple things. One is that these loans are amortized, meaning you need a financial calculator to do this. I used to use an HP 12C that I learned when I got into commercial real estate. The associations tend to have a lot of the qualifiers that they'll use to amortize loans. If you don't have a smart calculator or a smart device, I would just use the phone or the tablet or iPad, things like that, and just go to your device and download a free amortization tool, and then all you need to do is plug in the first trust deed, the interest rate, and the terms, and it'll give you the payment. All real estate agents have a general idea how to calculate payments, in my opinion, and it's so helpful when you're buying cars and everything else. So know how to do that, learn how to do that. If you still don't understand what I'm saying, go see a lender. Lenders will help you learn how to amortize payments. You can't just do it with a regular calculator. So know that. Also know that there's different types of loans. When you're buying a property 1 to 4 units, well, that's residential, right? So technically we should be using the comparable approach when we are talking about residential real estate and how we should determine the value. In fact, let's talk about the 4 ways to determine value real quick that you learned when you took your real estate exam. So Stephen's going to put this in the chat bar for you. You have the comparable approach, you have the cost approach, you have the income approach, and you have the capital asset approach. Those are the 4 ways to determine value. So you have the comparable approach, that's 1 to 4 units, residential. and even 2 units, 3 units. Technically, we use the comparable approach. And then you have the cost approach, is what developers use for vacant land. So you might remember highest and best use, that term in your exam. And then you have the capital asset approach, which is for risk of loss. So if I have a $5 million property, I have money tied up in this property that I can't use to purchase something else, another investment I might miss out on. So there's a risk of loss there. This is the income approach. What you're looking at here is we're using the income approach. So know that there's different ways to determine value depending on the deal. Sometimes real estate agents will look at 2 units and 3 units and they'll use an income approach, and it's really technically the appraiser's not going to, because it's residential for the most part, but you need to kind of look at the income, right? Because it is an income property. So you want to take those things into consideration. You also want to know that loans are handled differently. Residential 1 to 4, they're going to pre-qualify me. They're going to look at my income, my credit, my history, as most of you guys know on here. If I'm going to buy a commercial property, let's say I'm going to buy 10 units, apartments, never move in, well, they're not going to look so much at me now. They're going to look at the asset to make sure it has enough cash flow for them to do the loan. So sometimes if you have a buyer that can't qualify for residential, you can move them to commercial, get a commercial loan, and they'll get financing because they're not going to look at the person so much. And then you have an owner user. If I buy a warehouse and I use it for my business and I occupy 51% or more of the space, I can get an SBA, Small Business Administration loan. And now we're going to get back to my business in terms of qualification and income and the credit and the history of my business, and not so much the asset now, because it's a different type of property. The lender's looking at this as an owner-user, owner-occupied property, even though I don't live there. And so I can get better loan that way on a commercial property. I can get maybe 10% down, 15% down, a nice fully fixed amortized loan. So you can get better loans in commercial real estate with owner-user type property. So keep those things in mind, because the investors that I know, all of them, look at all those different things and methods and vehicles and ways of determining how they want to buy, if they want to buy, and what we call upside in the deal is can they make more out of it? So those things that I just said are really important. Now, there's, Stephen, did you put that in the chat bar? Okay. Cool. Thank you, sir. So now we're using the income approach, and what we're doing here is we're using what's called the scheduled gross income. So the SGI is the total income of this asset, total monthly income multiplied times 12, and it's called the SGI. And that's where I'm getting this number. And I'm going to use a 5% vacancy factor here. So I'm just taking 5% of 88,830 to get 4,442. And then I'm going to subtract it. I'm going to take 88,830, subtract 4,442. It's going to leave me with what is called my gross operating income, my GOI of 84,388. Then I'm going to take that times 35%, and that's where I'm getting my expense factor. And then I'm going to subtract it, 29,535. I'm going to take that from 84,388, and it's going to give me my net operating income of 54,852. Now, this can be a little complicated, especially if you're not good with math, or if you're not familiar with these numbers. Again, I don't really have time to kind of go over and over and over it. You are going to get the recording and the handout, so you can go back and pause and go through this. I'm going to give you some blanks, some exercises that you can practice this stuff. You should also consider going to some of our other classes so you can really understand this. I do want to point out that there's vacancy factors and expense factors. What usually comes up in my classes is people say, why are you using 5%? Why are you using 35%? Are those factors normal all the time? And the answer is no. So there's two, your lender is going to require us to use certain minimums, just like in residential real estate, they have ratios. It's been a while since I've done a residential deal. That's not an investment property, but they have ratios, right? 38 over 42 and 28 over 32, things like that. Same thing here. They're going to require a minimum of 5% for vacancy and a minimum for 35% for expenses for multifamily in a densely populated area. So I'm sitting here in Seal Beach, California. Irvine, let's use as an example, down the street, densely populated area. We really shouldn't see any vacancy factors less than 5%, because the lender is going to require a minimum of 5%. Now, let's say that I fly to Texas or rural area, this number is going to change, right? Because it's not as densely populated in that area, so that number is going to change. So there's two things that, write this down, there's two things that change my vacancy and my expense factors. One is the area, two is the product type. One is the area, two is the product type. And Stephen's putting things like that in the chat bar as we speak. So those change the factors. So keep that in mind, that you're not always going to use 5, you're not always going to use 35. It's going to change based on the area and the product type. So if it's a house, you may not use that. If it's 2 units, you might use something completely different. Now, you could also go from averages like managers, property managers. Hey, what are you seeing? What are you doing? But your lenders aren't going to go by that, right? They're going to, if I have property and my average historically vacancy factor has been 2%, for example, the lender's going to say, okay, that's great, good job, but we're going to require 5. So when we analyze the deal. So you can go off of property managers and kind of get an idea what's normal, but know that the lenders are going to look at that with their criteria. Now your expense factor is going to be a minimum of 35%. It might be higher. It really shouldn't be any less than that for multifamily 5 and up units. It might be higher based on the type of meters, master meters. So if there's only 1 meter for the entire place. If it's if they're burning a lot of air conditioning or a lot of heat in some parts of the United States, some times of year, it needs a lot of work, the expense factor will go up, never really less than 35%. Again, that's for multifamily. A product type, right? So if it's a triple net, what's triple net? Triple net is tenant pays taxes, insurance, and maintenance. TIM, taxes, insurance, maintenance. If that's the case, well, then the owner is probably not going to have a 35% expense factor, but there still should be something in there, and the lender is going to require us to plug something in. So I'm going to contact my lender and say, hey, what should I plug in there? And they're going to tell me. I like using my lender's numbers because then when the buyer or seller sees it and says, well, why are you using that? I can say, hey, this is the lender's numbers. We want to analyze the deal through the eyes of the lender, and they're going to require us to use this number rather than it's mine. See, so I like to use that. So you see how the product type is changing the vacancy, the expense factor as well, same as a house or 2 units. So we want to go to lenders and use those guidelines. Okay, and then we're going to continue with the math. We're going to take the NOI of 54,852, subtract our debt service payment. I walked you through how to get that earlier, and that's hopefully going to give us some cash flow. And then you have, I'm going to go to the next column for the other 2, debt coverage ratio and return on investment. I'll explain that in a minute. So I'm just going to go over to this next column. You can see we're doing the same thing. Market rents, we got more income. We do what's called rent surveys, lease surveys to see if we can raise rents. And then if we, because we're looking forward to see if there's upside, right? And here in this case, we can raise those rents, assuming there's a market where you can do that. And I get COVID is in fact affecting some of this with the ability to not be able to do that and things like that. So I get it. You just have to go by what you can and do what you can during the time that we're in. So let's say you can raise those rents. The other thing is, well, should I even raise rents? And maybe not. I'm not talking about those individual cases and things like that. I'm just in general. You raise the rents, 101,000, multiply it times 5%, gives us 5,000. We subtract it, gives us 96,000. We multiply 96,000 times 35%, gives us 33,000. We subtract 33 from 96, subtract 33, leaves us 62,000 for our new NOI. And then we subtract our debt service payment, which didn't change. And so you can see we have more cash flow here. So our cash flow went up. So I want to finish this part up with pointing out debt coverage ratio and return on investment. Return on investment is super important to investors. It's everything pretty much. Your debt coverage ratio has to do with the lender. The lender is going to decide if they'll do the loan based on what they call debt coverage ratio in commercial real estate. And it has to have enough cash flow. And without going into too many details, the debt coverage ratio in today's world is more like 1.25, just so you know, 1.25 minimum debt coverage ratio based on the product type. So remember, multifamily, office, retail, industrial, land. So the higher you go up the pyramid, the more riskier the investment's going to get. So the higher the debt coverage ratio likely will be. But there's only 3 ways to raise the debt coverage ratio. If I'm here and I need to go over here, there's only 3 ways for me to do this. So write this down. The 3 ways to raise this debt coverage ratio: more money down, lower price, seller carry. More money down, lower price, seller carry. So Stephen will put that in the chat bar. Those are the 3 ways to raise the debt coverage ratio. And it's important because if you're doing a commercial loan and the debt coverage ratio is not high enough, as you can see, it's not in column 2, you can only do one of 3 things: more money down, lower the price, or sell or carry to get that debt coverage ratio. Otherwise, you're not going to get paid. And everyone likes to get paid, especially when they do a deal or they're buying something. So you want that, you want that deal to go through. Now, sometimes people will say, hey, let's raise rents to get the debt coverage ratio up, or let's lower expenses to get the debt coverage ratio up. And that is not going to work most of the time. See, and here's why. If you're loaning somebody $1 million, do you want to loan that money based on what they say they're going to do or what has been happening? Well, the answer is probably, I'm going to loan only on what's been happening. So they want to go by what's called seasoned. They want properties seasoned in order to do their loans typically. They don't want to go on market or projections or some sort of pro forma typically. Now, again, you might have lenders that will say, oh, well, we'll do that. I'm fine with that. We'll go with projections. We'll go with market. We'll go with pro forma. Maybe a lender has a good relationship with an investor and they do lots of business with them. Those are some exceptions, but not the norm. So those are the 3 ways to raise the debt coverage ratio. The last column is a seller carryback, and it's a little advanced right now for our time frame. But I think what always happens is people say, are seller carries common? And the answer is no, they really haven't been. I don't see much of that when there's a lot of cash, when there's a lot of money, when the market is hot. But guess what's happening right now, folks? The market's tightening up. I'm sure you're seeing and hearing, experiencing this, residential and commercial, and it's about to get tighter. The forbearances, think of what's happening with people. Those forbearances, they think that these lenders are all going to put those lump balloon payments on the back end of their mortgage payments. Well, they're in for a big surprise because that's probably not going to happen, not with all of them. So they're going to have to deal with these balloon payments. And what that tells you, it's a little off track, but what that's telling you is that the market is going to be a little different, most likely in 12, 18 months as that starts to show up. So keep that in mind, keep those things in mind. But it also means that money is tightening up, most likely, and that lenders are not going to want to continue to loan at the same levels. At some point, we can't keep printing money. At some point, things are going to start to come to a head here. And so in commercial real estate, it's definitely happening. So understand, when those things happen, seller carrybacks, AITDs, all-inclusive deeds of trust, private annuity trust, deferred sales trust, all these vehicles become very popular. And so I just want to mention it to you in here on this class because we don't have really time to go deep into it, but I would suggest you kind of learn and understand, if you're not familiar with second deeds of trust and how they work and how it can be beneficial to both buyer and seller. You can see in the second column here, again, without going into it, we deferred the second payment. We deferred the interest on the second note, so there's no payment on the second. And what this does is it allows the buyer to go in and stabilize this asset. The seller's carrying 20%, 26%, roughly $210,000 for this buyer. And this allows the buyer to go in and stabilize the deal, fix it up, rehab, go in and get all this additional cash flow for 3 years, because we did this for 3 years. Look at their return. It jumps way up. Debt coverage ratio jumps way up. The owner, by the way, the seller, is getting paid 11% on their money. So this is attractive as heck to the seller and the buyer. The lender's okay with it. Everyone wins. And so this is some things you should get really good at and understanding, especially understanding the risks, because there are risks with it. Here's an exercise that you guys can practice. Here's on your own time. Price is $725,000. You want to take 25% of that because this is a down payment of 25%. So hey, Michael, I want to buy this deal with 25% down. What does it look like? So $725,000 times 25%. It's going to give you the down payment. You subtract the down payment. It's going to give you the first trust deed. When you do that, then you drop down here and you work on this part. You take the scheduled gross income, multiply it times 5%. That's going to give you your vacancy factor. When we have more time in our classes where there's more time, we'll walk you through this. We'll listen to your answers in the chat bar anyway as you're doing it. And you can put your answers in and we'll look at them and say, okay, yeah, looks like the majority of the room is getting this. And we'll keep moving forward. So we'll move you forward at a slower pace in some of our other classes that we do, but we just don't have the time to do that right now. I just want to skim. Again, you're going to get the recording, and you're going to get the handout so you can practice this stuff on your own time. So you take the 5% factor, which is $5,700. You subtract it from the scheduled gross income. It gives you your GOI of 1,083. Multiply that times 35%, and it gives you your expense factor. And then you subtract the expense factor from the GOI to get to your net operating income. You take the net operating income, subtract your debt service payment to get to your cash flow. And then you finish with your return on investment, your debt coverage ratio, and your cap rate in GRM. And where do you go to figure that out? The Glossary of Terms. If you don't even have to be a superstar with math. You could just go to the Glossary of Terms, and it'll walk you through every step of this spreadsheet, okay? And then the answers, there's some blanks for you to practice on, some additional practice sessions that you can do, and then the answers are there so you can correct yourself and make sure that it went good. I've also thrown in another exercise for you that is another seller carry here, and this one's interest only, that's not deferred. So, and then you've got the blanks, and then you've got the answers right behind it. So these, I've given you a couple exercises that you can use and practice as you're going through this, and can't recommend that enough. Obviously, practicing is very important when you're doing this. This part I always like to talk about because it has to do with the various tools that we use in the industry to buy, sell, everything. With me, everything's systemized. With our teams, everything is systemized. In residential real estate, by the way, we were doing 100 deals a year for years. Everything was systemized. Commercial real estate, not so much. You know, they don't have a lot of systems in place for commercial. It's kind of the wild, wild west. Investor market, same thing. There's not a whole lot of systems in place. I like to use what's called a grid system. In residential, it was my farm, and when I was selling, right, listing and selling at a high level. In commercial, it's a grid, and investing, it's a grid. So this is my way of getting inventory, listings, properties that are off the market, not on the market, exclusive listings. So I'm obviously an active real estate agent as well as an investor. But I also can use this for getting deals. It works well for getting deals. And then I like to have what's called an internet system, which is a buyer system. So if I'm doing sales, I'm using the buyer system, matching it up with the seller system to double end my transactions or sell my transactions. For investing, I'm going over here for buyers because I sell too, right? So I have listings that I buy, I flip, we sell. So we need buyers. So here's a pool, a way to get investors, and you can just, you're on your own. This is like your own world. I love this because this is I drew this out on a chalkboard years ago when I was at a hotel, and it just hit me. And we started on a chalkboard and started becoming classes and just developed from there. So this puts you in your own little world where you're systemized and you're not dependent on the outside world. This is why I love this, because you are in a place where you can control your market, your business, and your life. And this is for investing as well as selling. This one is the third system, is a sphere or referral, automated. That's what what makes these things systems. Save yourself time, energy, and money, is that it happens without you. It happens without your efforts. If it's up to me, it's going to break down at some point, right? At some point, I'm going to get sick, or I'm going to, not do it, or get busy or something. But if it's automated, it happens every single day. And what we're talking about is lead generation. When I say it happens, we should be getting leads, looking for leads every single day, looking for leads. How many conversations did you have today, this morning? How many conversations did you have? You should have already done it. You should have had at least 6 to 8 conversations this morning. Every single day you should be doing that, whether you're looking for sales, listings, or properties to buy for investing. It's all lead generation. And that's what we're talking about, is automating each one of these systems. And then the fourth system changes. So I like to have a seller system, a buyer system, and then people that know and trust you. Sphere, past clients. I like to keep these 3 constant and change this 4th one depending on what's going on. So when the markets shift, it's dangerous to keep doing things the exact same way. When the markets shift, we should adjust. Well, again, whether we're listing, selling, or investing, things are different. What are our investors doing right now? Are they doing the same thing they were last year? No, heck no. It's a completely different market right now. So this is a market of the moment, is what this stands for, MM, market of the moment. short sales, REOs, expireds, maybe as the market continues to become distressed, where if it's a hot market like it's been, maybe it's more press release system, marketing system. So this fourth one we change based on what's happening in the marketplace. All of our classes that we do and all of our content is based around these four classes, these four systems. And just depending on what you're attending and how much time we have will depend on what we cover. It could be a seller system, a buyer system, or a sphere system, or one of these systems. So each one of these has its own little class or curriculum, if you will. The goal of this, you guys, generating leads automatically, systematically, without your effort, so that you can have conversations, 6 to 8 conversations a day, easier. Now, what I'm going to do here is I'm showing you different types of return on investment and how they impact the deal. I'm going to blow up the center, and I'm blowing up the bottom. Here's the center, and you can see here that we have a 2.76 return on investment, all right? So I was writing this offer up, and this investor is looking at the deal, crunching the numbers. I'm typing, and I can see him out of the corner of my eye, and he's shaking his head. So I knew something was wrong. And he said, Michael, the 2%, you got to be kidding me. Tell me again why I'm buying this. Well, if you don't know how to answer that question, what's going to happen? He's probably just going to walk away. So this is what's called cash on cash. This is when you might see that a lot. You might see CC some places. CC, cash on cash. How much money did I put in the deal? And what's my return on investment? Cash on cash. You can't quite see it on the slide, but it's down below. CC. How much money did I put in the deal, and what's my return on my investment that I put in the deal? Okay, that's called return on investment before taxes. That's all that means. So what I'm showing you here is the after-tax return and the benefit it has when we take into consideration the benefit of owning real estate. So what happened was, when that gentleman said that, that investor said that, I said, well, remember the benefits of owning real estate. Benefits of owning real estate are taxes paid, interest, taxes paid, taxes saved, interest paid, principal reduction, depreciation. Trying to go too fast. Taxes saved, interest paid, principal reduction, depreciation. And this is actually, we have a slide for this. So these are the benefits of owning real estate, guys and gals. We shouldn't be talking only about appreciation, because the market doesn't always appreciate. Is it appreciating everywhere right now? No. These other benefits we always have, as long as the government doesn't change the laws. So we should be talking at the highest mountaintop that we can about the benefits of owning real estate, because this is it right here. And look at what happens when you take these things into consideration, how it impacts the deal. Again, when we have more time, we'll go through more math. I'll show you this with you, I'll teach you how to do this. By the way, there's not very many people out there that know this stuff, and certainly don't know how to sit down, show investors, talk about it. This is why Stephen and I and our team have done so well, is because we're masters, we're students, and we're not just genius, right? We master, we learn this stuff inside and out, forwards and backwards, and then we can have a conversation with investors and show them how we can help them achieve their goals faster, right? Using these things. So this is important if you like it, right? If you don't like it, well, then you don't want to spend the time. But if you like it, if it feels good to you, then learn it at a high level, because you can really do well and make a lot of money as an agent and certainly as an investor. This is just showing how we take the NOI, we subtract the interest paid, we amortize a loan, and then when we amortize a loan, we can turn around and say, hey, how much of that loan is going towards principal and how much is going towards interest in any given year? Okay, so I'm just using the first year they buy it. This is how much is going to go towards interest. Then we're going to depreciate the land, right? We don't depreciate the building, we depreciate the land. So we're going to use the straight line method, which is what that SL stands for, depreciated over 27.5 years, which is the residential time frame. Residential can be one house or 1,000 units. Commercial would be 39. So if it's a commercial building, we would use 39. And we're going to depreciate the property. Once we've done that, we can calculate the taxes. So I'm going to go back to that initial screen. I'm going to plug the taxes saved up here, add in the principal reduction. You can see our return now is $19,927, which gives us our almost 8 as a total return on investment after tax. So when that investor said, gosh, why should I buy 2%? Why am I doing this? Remember the benefits of owning real estate: taxes saved, interest paid, principal reduction, depreciation. You can see your return is almost 8. How do you feel now about buying this property? And the investor said, oh yeah, okay, I remember that now, keep going, right? And they bought the deal. So understanding this at a high level can be very helpful for you. The 3 different types of return on investment here: before tax, after tax. So what I just showed you is the after tax and the before tax. you should always at least look at after tax, in my opinion. Internal rate of return, IRR, REITs, real estate investment trusts, like Brittany was just talking about, that's going to be a good class, looks like to me, that's coming up. That's really all they look at is internal rate of return when they're doing their deals. It's all of the gains, all of the losses, the entire time they've owned the asset, okay? So those three different types of returns, understanding that and understanding which one you're dealing with and which one to look at. We'll end with this. This is the grid system. So that first system was the grid system, and this is the doctor scenario. And the doctor bought this property for $1 million. Loan was $750,000, equity is $250,000, cash flow is $25,000. Fast forward to the future, the value goes from $1 million to $1.8 million. Is it realistic? Property go from $1 million to $1.8 million? Yeah, depends on the area and the market and all of that and how long. Loan goes to $650,000, equity goes way up, $1,150,000, cash flow goes way up, $50,000. So what my experience has been, owners in this situation think they're doing well, and maybe not. And what we'll teach you when we have more time is what's called return on equity, ROE, diminishing return on equity. And we'll show you the whole financial analysis that you do when you're calculating this. It's not that hard, by the way. Those numbers I went through, a lot of you might be going, oh my gosh, it's because it's the first time. That's all. It's new. Just like when you took your real estate exam, some of that stuff was new. It's repetitive, though. What I just showed you, we just do over and over and over. We get down, we understand, then we use spreadsheets, and we don't have to keep doing it, okay? So it gets easier, trust me, and then you start making money. So we'll show you how to do the full-blown analysis, but this is a shortcut. Cash flow divided by equity gives us 10%. So when the person bought it, it was an ROI, return on investment. Well, what we do is we stop looking at the down payment versus the cash flow versus the down payment. Cash flow versus down payment is what's called ROI. Cash flow versus equity is what's called ROE. Two different things. Okay, so this is what we're looking at now. Now it's 10%. Well, fast forward to the future, you take the cash flow divided by the equity, it's 4%. 4. So what's happened? Well, my return on investment, my ROE, diminishing return on equity, is diminished. My return is diminished from 10 to 4. It's going to go 10, 4, 3, 2. It's going to keep diminishing until I exchange it, until I put this dead equity back to work. So see, I thought I'm doing well, but I'm not. This dead equity sitting there is not working for me anymore, and my return is going backwards. In theory, and then we're about to wrap this up and answer any questions you've got. In theory, I can buy a property in parts of the United States with 10% down. I buy 10, 20, 30, 40, 50%. At that 50% mark, this goes for residential, I don't care, any property where you hit a 50% equity position, the return is going to, now we're only talking investment property, we're not talking about the house you live in. Once you hit 50%, the return is going to go backwards. It's going to start to diminish. Most people don't realize this. This applies to a single-family home. If it's free and clear, the only reason someone's sitting on a single-family home free and clear is because they don't understand this concept. Because I can take this property, sell it for $2 million roughly. I take my $1 million of equity and I can buy a $4 million property. Would I rather own a $4 million building or a $2 million property that I own now? Well, probably a $4 million building or property. If my goal is to grow, and exit, if that's my goal, then that's what I should be focusing on. If I need this cash flow, which happens to some people, they say, look, I really need this money. I can't live without it right now. Well, then they're kind of stuck. They have to just, sit on it and keep that cash flowing in. But most investors, a lot of investors I know, what are they doing? Why are they investing? They're investing so that they can exit at some point. Okay. So this approach applies really well. And what we do is we target people. We target people based on equity. All of you can figure that out, how you find property sitting on equity. You target them. We have scripts. We have approaches where we're not asking them to sell, because why? That's what all the agents do, is they ask people to sell. And to me, that doesn't work. I've learned that doesn't work anymore. Back in my sales days, when I was doing 100 deals a year, I've learned a lot, right? Consult instead of sell. So when you're consulting, you're approaching people saying, here's the different ways I can help you. See, and that's what we're talking about. Everything we do is based on consulting versus selling. And then we are waiting for indicators that tell us it's time to start talking about real estate and look at their deal and start getting into that stuff. But we don't lead with that. So we target people sitting on a bunch of equity. It can be single family homes. It can be any type of property you want. And then we approach them using key scripts and benefits that we provide to them to consult them. And then we either help them understand why we can buy it as an investor, or we can list it and sell it and help them achieve their goal faster through written real estate investment planning strategies. So I want to be respectful for time, and we are at the end of this. I'll finish up with this. Again, high unemployment, lack of significant job growth, and limited capital are all working together to recalibrate the real estate market. We need to use our knowledge to not only serve our clients, but also seek opportunities to invest. It's so important that we think about that. A skilled and knowledgeable professional who can work with landlords, tenants, and even lenders will be extremely valuable during this time. You can use your commissions. You can use your commissions to earn the knowledge you have to invest in the products you're selling. The first house we bought with our commission. We bought a mixed-use property. I ran my business out of this. You remember this, Stephen, I know. And we ran our, we had 3 units in the front that were storefronts, and we had a house in the back that we lived in for a while. We bought that owner occupied so we can get use the commission, get a good loan, and then we converted it to investment property. And that's kind of how we got started. And you can just grow from there. So I'll end with this story. I had 6 units on Hollywood Boulevard that I always talk about. Stephen likes to use the one in Newport Beach, but I really, this one hits home to me. I had the ability I listed at $600,000 at the time, that's the value. And I had the ability to buy that property. The thought did go through my mind, but I was so caught up in the commission, double ending this thing, and I ended up double ending it and just selling it. Well, that same 6-unit property on Hollywood Boulevard today is probably worth $5 million plus. I should have bought that thing. And you can buy deals. You guys all know this. You have the ability to buy, and we just get caught up in the money, in the commission. Think buy. There's money out there. There's hard money to help you finance these properties. I know lenders now. I know people. I know investors that have unlimited amount of capital. They say to me, Michael, you find a deal and you can't fund it. You need help with money, come to me and I'll put up the money. I'll do the deal with you. I'll put up all the money and we'll partner. I'll just take a piece. So there's people out there that will do that. Think about it. If you find a deal and you know it's a deal, and it's a sweetheart of a deal, it's a great deal, but you can't find the money, you can find the money. And if you can't find the money, start asking around, reaching out, because there's money. Okay. So don't let anything stop you from achieving your goals. Go out there and get it. You deserve it. And you deserve to have a lifestyle that you want to have. And certainly when you retire and stop working, which at some point we're all going to, you deserve to have income coming in, and lots of it. Thanks for your time. We'll stick around and answer any questions you've got.
Excellent job, Michael. Thank you so much for that wonderful presentation. We really do appreciate you sharing a lot of insight today. I know it was quite a bit, but I just want to remind everybody that we will make this recording available for your review on Friday, August 28th. You'll visit nar.realtor/CFFW/webinars. Let's go ahead to our Q&A slide. I'm going to go ahead and switch over here. Now at this time, for members who are listening in, it's not too late to submit a question. Simply send a message in the chat, or you can email us at financialwellness@nar.realtor. So I'm actually going to turn it over to Stephen to dive into our Q&A, or as well as our chat. Again, you can look here at the slide. If you have a question directly for Michael's team, we have also put their email there as well. So Stephen, turning over to you.
Thank you, Brittany. Great job, Michael. I know it's a lot of information to cover, but we do have some questions. Mary asked earlier, what are the best steps to select residential property to purchase for investment or flips? And how can I get the sellers, which are generally REOs or foreclosures, to accept my offers to prevent financial losses to us, the investors, due to repairs, both known and unknown?
Well, that's a lot. That's a good question. That's a lot to answer. One thing though that just comes to mind is that I noticed and learned is, and some of you guys have probably seen this, is go to the listing agent, right? So if there's a deal to be had, don't worry about the commission. Go to the listing agent. Let the listing agent do, as long as you feel comfortable, with the ethics and all of this. of that agent and things like that. But when you try to get in the middle, you lose the deal a lot of times. If you try and get it in the middle of it as an agent, go directly to that listing agent and just say, hey, what do I need to do to get this thing? Help me get it. You can represent me. You can keep the commission. I just want the deal. And that'll sometimes streamline it.
And Ross asked, how do you suggest I look at real estate investing given a client shorter time frame or horizon, age 60 and older, so helping those 60 and up?
Yeah, you know, I'm going to pass. I'm going to pass on that because that's a legal question that I don't want to answer, especially this being NAR and we've got different states and everything. So I'm just going to pass on that altogether. Sorry, Ross. I go see a title rep, title company in your city, state, county, or an attorney, and they can advise you with that.
There are also a couple questions here in the chat. Should you just take the equity out if you still want to own the property?
Yeah. So you mean you refinance? So when you refinance, you're not getting maximum LTV. You can purchase loan to value. You can purchase and get a better loan to value typically than you can a refi cash out typically. The other thing about refinancing is that it doesn't reset the depreciation schedule. So one of the benefits of owning real estate is depreciation. The only way to reset the depreciation schedule, remember it's 27 and a half years or 39 for commercial, and some investors will accelerate the depreciation. So especially foreign investors, they have the ability to do that. So they could have used it all up in 10 years or so. And after 10 years, they don't have any depreciation at all. What they should do in that case is exchange, just sell it, reset the depreciation up to the exchange rate, level that they're purchasing the other property for. So you can do that. I know a lot of people do that. They'll refi. And you can do that. It's a strategy that's used. Again, those would be the pros and cons, or the cons anyway, of doing that.
Perfect. And then there was a follow-up to that, I believe by Doris again, where she said, you said
hey, real quick, Stephen, I'm sorry. The gal who asked that first question, I'm sorry, I don't remember your name, but I'm trying to think of the reason I'm delaying is I'm trying to think of some other ways to answer some more short answers. One of the things she said is, how do we find these properties, right, and deals? Well, one of the things that I've also noticed about big time investors around, and I'm not trying to say I am, but I know a lot of, and they all are well known. They're known as the investor. They're known as the go-to. If you can make yourself known, hey, come to me, bring me your deals, and then once you perform, you do a deal or two, because that's the concern. Okay, if I bring you this, are you gonna mess it up? Are you gonna close or not? Because I want my commission, right? And so once you perform for that agent, assuming that agent brought you the deal, then you're known as an investor, as a go-to. And so once you become known, you can work referrals. You get word of mouth. Hey, go see Stephen. He's a guy who does a lot of these deals, and he's got money, and he did a good job, and he closed in 10 days. And that's how you can go about picking up deals right and left, is by being known as a go-to.
Awesome. And then what's the best to do right now? Flip or buy and hold?
Well, it depends on your strategy. That's a great question. I talked about two different investors earlier that I know real well. One is a flipper. He loves flipping. And I prefer to hold. And the other investor that I know, the one I referred to anyway, prefers to hold. I prefer to hold, but not at more than 50% equity. So I like to hold properties, but once any property gets to that 50% position, then I like to exchange into something else. So that's kind of my personal opinion.
And then great follow-up to that. You said that if an investor wants to grow, they would maybe they would take the money out and exchange up. But what if they want to keep the property?
So if they want to keep the property, same thing, that's fine. Buy, hold. Just once it gets to that 50% position, take a look at it and see if that return what I didn't say there on that is that return was 4% ROE. In some markets, that's a good return, 4%. They're like, oh, I can't do any better than that. That's fine. I'm happy with that. Okay, fine. Let's wait. Let's look at it another year from now. In other markets, most 4%, I can do better. So if I can do better than 4%, let's go. Let's exchange this and get me a better return than what I'm getting right now. That's what we look at. That's what I'd like to suggest you look at. Hey, Stephen, also, by the way, as we head up to the 11th hour here, be sure to put Dana's email in there and in the chat bar. And we have a link that you can click if you'd like to go to one of our other classes. We don't charge anything for the classes that we're referring to right now. I want to make sure we get that in there before we wrap up.
Absolutely. And that is in the chat. Thank you, Dana, for doing that.
Awesome.
There was another question let me scroll up. Are off-market real estate deals the best?
Oh, that's the end of the question. Sound like we're going to add to it. Or off-market.
No, I have another question after that. But yeah.
I think Brittany has put this slide up here. This is one of our 3-day courses. Thank you for doing that, Brittany. Yeah, we do a lot of different classes, you guys. We do 1 day, we do 3-day, we do investment courses, we do REO, short sale courses that we are rolling out. We have a lot of stuff. This is what we do. This is all we do pretty much is coach, teach, train across the United States. And then we also have a team that Stephen spearheads. So we do a lot. Right now, I would just say, hey, go to a series. Go to a free series we have. They're 2 hours. They're 1 p.m. Pacific Standard Time. That's what that link is that Dana put out there. You can get a flavor. You can get a taste of our style, what we teach, what we talk about. And then from there, if you want to inquire about our 3-day courses and coaching for them and things like that, you can. But I would suggest just go to the free 2-hour series, get a taste, and make sure you like this stuff. But thanks for showing that slide, Brittany. I really appreciate that. So,
and there's
off-market deals are, people like off-market deals. They tend to like off-market deals. Sometimes an off-market deal is not better, though. Sometimes an off-market deal, the owner wants more money than anybody else, like a FSBO for my owner. So I wouldn't say it's a blanket statement, but I would say that it's extremely common that people prefer off-market transactions for investing.
Perfect. And then this is kind of a longer answer, but 1031 exchanges, good, bad, or ugly?
1031, what would it be ugly? I'm not sure I'm understanding that. But, I mean, they're good. I mean, you have to do them to avoid taxes. You're usually exchanging up. It's usually a good thing, but they can go bad. You can have multiple chains, right? Been there, done that, which makes it kind of difficult. But I don't see a downside to that right now, other than something going wrong in the deal, which happens anyway all the time.
I think, unless I missed one, Brittany, I believe that is all the questions that I see.
Okay.
I know we're a little over on time. If the link isn't working, you guys, you are more than welcome to email Dana, and we will get you the information for the free 5-part series that Michael was just talking about. Oh, here's one more question, Michael. Isn't 1031 just defer, die, and pass along to your heirs with a step-up basis?
Yeah, pretty much.
Yes. Getting a rental ready to sell right now and considering not doing a 1031 exchange.
Yeah, so that tax question, right? So the downside would be you're going to have some capital gains that you get hit with that you've got to look at, but you could also look at some other options, seller carry, some of the vehicles that I mentioned that will be able, that you can invest in if you're looking to invest in something else and get a good return. But that would be definitely a tax question in terms of what kind of hit you're going to take when you do not exchange it.
And I believe that is all. Brittany, if you want to take it away.
Sure. If you guys do have any other questions for Michael and his team, please feel free to email him. It will be training@thencrea.com, and they will be happy to answer those questions for you. So now at this time, Michael, if you could leave us with one more closing statement, what would that one last takeaway be?
Investment property. Look at investment property and think investing. And think about investing all the time. There's so many different ways to do this, you guys. You could buy a duplex, 2 units, live in one, rent the other. And you can do that owner occupied and get a good loan, and then you can rent it out and move into your house. You know, a lender's not going to buy the fact that you're going to move into a two-bedroom duplex, two-bedroom apartment where one of them is a duplex. If you own a 3-bedroom, 2-bath house, it's 2,000 square feet. They don't believe you're going to do that. So it's hard to go backwards and do it the other way around. So just think invest. That's what this is all about, is don't get caught up in those commissions. Think about, investors think differently. And we've got a part 2 class, by the way, that I know Brittany's going to mention that we do coming up next month here. But investors think differently. The typical person thinks make money, spend. The investor thinks make money, save it, invest, and then I'll spend what's left, right? So they cut back on what they feel like the need versus have. They define the difference. I want that, but it's not a need, right? And you see it. You see them, they own real estate, they own properties, and they have cash flowing. And it's just at some point, we've got to stop working. So we're going to stop working. We need an income coming in. So, oh, there it is. So there's the upcoming class that we can hopefully see you guys all back at.
Perfect. Yeah, and that class will be available on September 30th. Again, to register for that, you will visit nar.realtor/CFFW/webinar. Same way that you registered for this one, we are doing a second part series to dive deeper into this topic. So that's all the questions that we do have at this time. This concludes our webinar, and we just want to send a friendly reminder for those who are listening in that the recording will be available on Friday, August 20th. Remember, you can save the date for our upcoming live event, which is on October 7th. For more details, please visit financialwellness.realtor. Lastly, again, if you have any additional questions directly from Michael and his team, there have been a couple of emails that have been sent out in the chat, as well as training at the ncrea.com. And don't forget, you also have access to additional resources provided to you through NAR's Right Tools Right Now resource. And again, this is a relaunch program which includes reduced or no-cost tools to support you through any challenging times. Visit nar.realtor/Right Tools Right Now, which is RTRN, to access webinars, educational resources, and timely market reports that are great for your business. So thank you so much for your time. This concludes our webinar. Special thanks to our members for joining the call. And thank you, Michael. We really appreciate your insight on today's topic. It was great.
Brittany, and thank you to Bill Brown and you and all of NAR. This is awesome that you guys are doing this. You really care about your members. Great job.
Thank you. And so again, everyone, the recording will be available on Friday, August 28th. At the end of this session, a survey bar will pop up on the desktop browser. Please leave us your feedback on today's presentation. Thank you. We look forward to having you join us for our next Financial Source webinar on September 30th at 1 p.m. Central. Take care, everyone, and thank you again, Michael and your team. Thanks, Stephen, and thanks, Dana.
Bye. Thank you.